So today we're going to be talking about the benefits of a single premium whole life insurance policy. My name is Gartner. I'm with Epic Financial Strategies. I'm going to go over 6 different benefits and one kind of drawback that this policy might have. The first thing is, what's a premium, right? I've been getting asked that question because we're talking about a single premium whole life policy, and people are saying, well, can I actually just make one payment into my whole life policy? And the answer is yes, you can, right? So the premium is the amount of money that you're going to put in that's going to pay for that death benefit that you'll have. So this is one of the main benefits, right? I get to make one payment and I don't ever have to think about this again. My estate planning, my family protection, it's done. The second benefit is because we're using whole life insurance, we have a guaranteed death benefit. And what that means is I've made my premium payment, my death benefit is guaranteed for as long as I live. It will never change. It will never go down. It will never not be there. The only thing it can do is go up. And the way that it would go up is from the third benefit, which is the dividends that are paid. The dividends being paid, it's going to serve 2 functions. It's going to grow that death benefit for you in the form of buying paid up additions, right? So your death benefit grows. That dividend check is coming in because you're likely using an insurance carrier that has paid dividends for 100+ years. So you might be thinking, well, what does it actually mean for the company to pay a dividend? What happens with whole life insurance is you are not just buying an insurance policy, but you're becoming an owner in that company that you're buying that policy through. And becoming an owner gives you a stake in the divisible surplus of that company. So the profits of the company come back to you in the form of a dividend. The next thing that dividend helps to increase is the cash value in the policy. Think about this. You can make one premium payment in, and in a couple years have this death benefit plus this cash value, and you could take that cash value back out and still have a death benefit over here minus the cash value that you've taken out. So what has that done for you? That's actually created a cash value or a cash that you can utilize today and still have a death benefit to protect your family. So what's really nice in this cash value is you can actually leverage that cash value and use it for other things and still maintain a death benefit inside of that policy. So you get the use of your money that you put in to have this death benefit, and that death benefit would just be reduced by approximately whatever you're taking out of the policy. So let's say you had $200,000 of cash value in this policy, and that policy has $1 million death benefit. Well, if I took $100,000 out because I found a real estate deal that I wanted to go put this money in on, well, now what happens is, unfortunately you pass away the next day, your family's still going to get a check. It's just not going to be for that $1 million death benefit anymore. It's probably going to be closer to $900,000 because you already took that $100,000 out and went and bought a property. But what's really nice is we're not betting on passing away, right? So assuming you're still living, you've just purchased this real estate property that's getting you a rate of return, and you have the money that's moved out of the policy into the real estate, but you're still getting credit and growth on that money as if it was still in there. Now, not every company does that, but the carriers that we're working with, a lot of them will credit your cash value as if the money was still in there, even if you've taken it out. One of the last benefits, and we do more on this in other videos, but there's riders that can access that death benefit in case you run into a long-term care situation. But let's get back to all the benefits, right? So we've talked about the cash value, we've talked about the dividend, we've talked about the guaranteed death benefit, we've talked about the growth in the death benefit, we've talked about a single premium and the riders to access. But I said there would be 7, and I said one might be a drawback. The one drawback to doing a policy in a single premium is that it becomes a modified endowment contract. Now you're saying, what does that mean? A modified endowment contract, really, if all we cared about was the death benefit, means nothing to you, because the tax treatment on that policy is no different if the policy is a MEC or a non-MEC. But if you do care about the cash value and the growth of cash value, what happens is a modified endowment contract follows rules very much like an annuity. That means if you're younger than 59 and a half, any gains you take out of the policy, they come out first, you pay a 10% penalty, and you also pay taxes on that. Most of the videos that you'll see us talking about life insurance, we talk about the tax-free income that can come out of them. If your policy is a MEC, that strategy goes out the door. A MEC is not all bad. It's really just where it fits into your situation and the type of planning that we're doing. If you like the idea of single premium, but you don't like the idea of the policy becoming a MEC, there are other ways for us to handle that. So if you're looking for more information for this, we've actually created a free course. Go down into the description box below, click the link, you'll get access to this free training. I'm Gartner, and I'm looking forward to hearing from you.